Good afternoon and welcome to this week's macroeconomics analysis session for November 27th, 2015. You're with DMAC and sitting alongside, as per usual, is Jeff Saffer. Welcome, Jeff. How are you?
Good, thanks, Dave, and hello, everyone.
All right, let's kick things off with our disclaimer first and foremost. The content of today's presentation or any other Elite Traders Club material does not constitute a recommendation nor does it take into account your investment objectives, financial situation or particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, Jeff, the week in review, the man there on the screen at the moment there, Stanley Fischer, who you have known about for quite a period of time, earlier in the week telling me that he has been very bullish on raising rates in the US. Is that right, Jeff?
That's right. So we call it hawkish.
Hawkish.
So
yes.
you're a dove if you support lower rates, and you're a hawk if you support higher rates. So you actually came to me earlier this week and said, look, someone from the Fed has hinted that rates are going to go up around the world, and I said, let me guess, it's Fischer, and you said yes,
correct.
So it's not a big surprise from him to hear him talking about higher rates, but this little statement you put on the right hand side is really interesting. Look, he said some major central banks could start putting up rates soon, and he said we've done everything we can to avoid surprising the markets and governments when we move. And the Fed continuously this year, or really actually for probably going back 3 years now, has said we're going to have to raise rates soon. Set some lines in the sand, pushed them back. The tide came in and got rid of the lines. They put a new line in. They've been doing that over and over again. But really, for the second half of the year, the Fed has been saying at some stage in 2015, rates are going to go up. There's only 1 month left.
Yep.
It's their last opportunity to do so, and finally, it's looking like that's going to happen. So, really, we've been talking about this for quite some time, but it is a very big deal. Certainly, it's probably, in my opinion, probably the biggest development in financial markets this year will be the Fed starting their rate rise cycle. And he's right, Stanley Fischer is right. They have done everything they can to warn the market that it's coming. There'll probably still be a little bit of shock here and there, but it's coming, get ready. And that's going to drive the markets in the next few months.
So certainly that will add to the volatility. So when they make their decision to do it, let's just say they do it in December, they make their announcement to the market, I think on the 16th of December, is that's the correct date? Now, if they go ahead and raise rates to whatever level, I don't know, where will they go to first?
Look, at the moment, it's officially between 0.25%. So it's not even a fixed amount. It's in it's a range close to 0. Typically, when they move rates, they move it by 0.25%. That would take it to between 1.25%.
Right.
If they wanted to be cleaner about it, in my opinion, and I'm not sure this will happen.
3/8.
Yes, 3/8.
Yep.
Very good. The easier way to do it would just be to say, let's just move it to 1/4.
Yeah.
Okay, so that's the smallest move, and really that's what the Fed is trying to do as well. Yeah. Right now, there's no threat from inflation. They don't have to move rates. There's no critical urgency, but they just need to start moving. Yeah. So if they move, the smallest amount really that they can move it to is just go from between 0 and 1/4 to just say, let's just call it 1/4.
Yeah.
So it'll either be that or it'll be that 3/8 as you basically said.
So if they do that, then the market is probably factoring that in.
Yes.
If we're reading into the market what it's possible to do at this point. If they don't do anything in December, does that create more volatility?
Yeah, I think it does. So recently, for a number of months, whenever there's been an expectation that the Fed was going to raise rates and it was building up to some sort of arbitrary deadline or suggestion that the Fed was running with, when as it got close to that deadline, there was volatility. Everyone's worried the rate rise was coming. And when it didn't, markets calmed down. In the last couple of months, I felt it's finally flipped. Now, everyone is expecting the Fed to move, and when they don't, everyone goes, "Oh, hang on, what's going on now? We don't really know what's going on. Is it because the US economy is weak? Is it the Fed? We can't believe anything they say." I actually think it's gotten to the stage where the market would actually be more comfortable with the Fed raising rates, which sounds unusual.
Yep.
That would take away the uncertainty.
Yep.
And so I think the Fed has got the message, and the Fed is basically saying, we need to just take care of this once and for all. It's been literally been waiting years for this to happen. Let's get the first one under our belt, and then we can worry about it from there. Let's get rid of the uncertainty. So I think actually rates on hold provides more volatility.
Yep. Okay. Well, that's interesting observations and assessment. I think of probably what is going to happen, and the fact that markets don't like uncertainty, and any glimmer of uncertainty through the Fed sitting on their hands and going, oh, we might just wait one more month. I don't think the market's going to like that too much at all. Important news from last week there, Jeff. You were away this time last week, but I went through and plucked out some sets of data that I thought were probably reasonably important. The main one there in Australia there, private capital expenditure. What's your read on that?
Yeah, look, it wasn't a huge week, but certainly kicking off with Australia, the private capex data looked disastrous. Expectations was for a 2.8% contraction, so for private investment by companies and the government in buildings and property and equipment and infrastructure. It fell the previous quarter, it was expected to fall again, and it just slumped. Now, most of this is from the mining sector. The mining sector, which has had huge multi-billion-dollar projects for the last number of years that are now starting to, the sort of building process is finishing. So the mining sector investment is slowing. We know that. That's not something new. But investment in buildings slumped as well. Investment across other industries kind of slumped as well. It was actually quite a disastrous result. A couple of very small bright sparks in there. Expectations of spending in 2015-16 was a bit higher than last expected, but it's pretty much a disaster. And it actually suggests to an extent that GDP in the next maybe 6 to 12 months or onwards could be slower, because if businesses aren't investing, then that's going to cut down on spending, it's going to cut down on hiring, it's going to cut down on everything. So you really want to see this capex start to pick up before the economy picks up. So I think we're getting towards the reality that Australia's medium-term outlook is pretty ordinary. Despite that, though, on Tuesday, Glenn Stevens gave a speech, and he was asked about rates and can we expect a rate cut next month. And Glenn Stevens actually used the word chill out. He said the RBA can afford to chill out, basically keep an eye on data. It's Christmas coming up, people are going to spend money. Basically really telling the market, look, the RBA, and they've been saying this for a while, the RBA is in no rush to cut rates. So the Aussie dollar popped up on that. So that was an interesting one in Australia. So just to summarise all that, economic growth not looking great in Australia. Despite that, the RBA is in no rush to cut rates. In the US, there was a Fed speech. There was really nothing in there whatsoever. But preliminary GDP came in slightly ahead of expectations. Interestingly, company profits slumped in the US, and consumer incomes and spending went through the roof. So with low gas prices in the US, consumers have got more money to spend, so they're spending over there, and that's actually pumping the US economy. Doesn't quite match up. Consumer confidence took a hit this month. I think that's on consumers just getting a bit worried about the Fed rate rise, but I think that'll be temporary. And flash manufacturing was a bit disappointing as well. In Europe, not too bad.
Well, those figures are up a little bit on previous times as well. Well, let's go through and have a quick look at the markets, what they've done this last week. The ASX 200 still remains in very high market risk mode at this point in time. It's really just looking for some direction, and I think This week with the US Thanksgiving weekend, etc., obviously the US markets are not really doing much, so hence not a lot of clear direction for our particular market. Volatility in our market just creeping up a little bit compared to more recent times. Interestingly, if we go through and have a look at the US market, you'll see the volatility, whilst it has been going down, continues to move in a downwards direction, and certainly the last week showing there really not a lot of clear directional movement one way or the other coming into this Thanksgiving weekend. And quite often there is a bit of a trend that once you get a long weekend in the States, that the market pauses, reassesses things, and you can sometimes get a bit of a change from that period in time. It will be interesting to see what happens with interest rates, whether we get a Santa Claus rally and whether that has any impact on that, whether the market's already factored that in and feeling comfortable with the way things are progressing, and if that's the case, then fingers crossed that we do get a bit of a rally that flows through into the Aussie market in particular. Our market at the moment is still down for the year. Certainly was up around 10%. From the beginning of the year, but since then it's just been sort of one downward slide. But having said that, Jeff, again, really just a bit of a pat on the back for you and your club. The number of stocks you've been in over the last 6, 12, 18 months that have absolutely massively outperformed the market, using your fundamental analysis as the decision-making tool to get in, has worked fantastically well with a lot of the stocks that you've been in. And I ran a webinar a few days ago just about using technicals to help with your timing of your fundamental analysis, and I certainly think there's a lot of merit in doing that, and hopefully some of the guys who are in your club, Jeff, have recognised that and got nice big fat bank accounts on the back of some of your selections. And certainly I've had a good look at some of those and traded in some of those myself and benefited along the way as well. So just a mix of using technicals with those fundamentals, and it's certainly very handy. You're all very lucky having access to Jeff's expertise in that area. Let's go through and have a look what we've got on the table for next week, the week ahead.
Yeah, first of all, thank you, Dave, for the pat on the back.
Sorry.
But yeah, look, obviously I approach the market from a fundamental perspective. You look at the market predominantly looking at the charts, and a lot of people out there think you have to choose one or the other. Even though I've been doing fundamental analysis for a long time. It's what I've studied. It's what I practice. It's what I teach. I have no issue certainly using a little bit, it's not a main determinant, but a little bit of technical analysis myself, and I certainly have nothing against people using a combination of both. And ultimately, I think fundamentals and technicals together are going to be more successful than just one on their own. So I'm definitely not sort of arrogant enough to suggest that fundamentals is the only way, but I think both of us would agree that sort of combination, if you can get fundamentals and technicals pointing in the right direction, I think you should be pretty well served. Back to the economics, yep. And the week ahead, a couple of themes here. Look, in Australia, cash rate. I think Glenn Stevens has already given the game away there. Yep. And GDP. Look, it could actually inch higher above 2% for this quarter year on year, but again, big picture, I think GDP is going to struggle in Australia for next GDP growth for a couple of years. And then in the US, it's a big week. Okay, so I mean, it is and it isn't. None of these things are going to necessarily move the market, but I believe that the Fed will raise rates in, let's call it, 3 weeks. Mm-hmm. And the only way they won't is if there is a major stumbling block between now and then. These are some of the biggest data points to come out in the meantime. They're coming out next week. So manufacturing PMI, services PMI as well. There's no expectation that these are going to slump. Jobs data has been a bit up and down recently. The last one was pretty good. Mm-hmm. So as long as the jobs data isn't disastrous, I think as long as you don't see any major disappointments in those pieces of data next week, I think you can expect to see rates being raised in a few weeks in the US. And in China, the manufacturing PMI is expected to be fairly similar to last month, around sort of low 48. So the Chinese factory sector is still contracting, but not too badly.
Yep. So just on that, just a quick question there, Jeff. We've got there Janet Yellen speaking, and then we've got Janet Yellen testifying. What's the difference between her speaking and testifying?
Testifying is basically speaking to Congress.
Right.
Okay.
Yep.
So she'll be giving testimony to either both houses of Congress or a particular sub-finance committee. So one speaking to the government, and one speaking to everybody else.
Yep.
Or anybody else.
Very good. Very good. All right, folks. Well, that's it for this particular week. So thanks for watching. Those of you in the Elite Traders Club, I will catch you bright and early on Monday morning at 9 a.m. for our regular weekly analysis session. So in the meantime, it's bye from me.
And it's bye from me.
Thanks for watching.
Thank you.